There was no press conference, no emergency statement, no central bank headline dominating the news cycle. And yet, in the early hours of December 19th, around 2:17 a.m., New York time, silver quietly crossed a technical and psychological threshold that had capped price action for months. Under normal market conditions, a breakout like that should have triggered disorder, volatility spikes, stress derivatives markets, visible instability. But none of that happened. The move was controlled, almost surgical. Volume increased, but it didn't explode. Open interest rose without triggering forced liquidations. Most telling of all, liquidity behaved in a way that did not resemble a market freely discovering price. Within 30 minutes, trade counts accelerated while order book depth thinned, a rare combination that suggests activity without competition, movement without resistance. By 2:47 a.m., futures volume on COMEX had nearly doubled compared to the prior hour, yet realized volatility remained compressed. That's not how panic buying or organic breakouts usually look. In a truly free market, stops cascade, spreads widen, slippage increases, and price overshoots before stabilizing. Instead, silver advanced in precise increments, repeatedly encountering resistance at nearly identical intervals, as if the market were being guided rather than chased. When European trading desks came fully online around 9:48 a.m. Central European Time, price was still holding above the breakout zone. Every attempt to accelerate higher was capped within a narrow band, not violently rejected, just quietly absorbed. That distinction matters. Violent rejection implies sellers. Absorption implies someone willing to take the other side indefinitely. History shows that when silver moves too quickly relative to its perceived monetary role, mechanisms appear to slow it down without stopping it, not through headlines or announcements, but through structure, margin expectations, liquidity provisioning, and selective pressure applied in places retail participants rarely see. By late morning on December 19th, discrepancies began to emerge between paper markets and physical signals. Retail bullion dealers reported tightening availability, while future spreads remained unusually calm, a divergence that typically doesn't persist unless arbitrage is being intentionally or structurally constrained. The timing matters. Just hours earlier, during the Asian session, spot silver had already shown signs of stress in forward pricing, while Western markets still appeared stable. That suggests price discovery wasn't happening everywhere at once. It was being phased, segmented by geography and by instrument. This kind of fragmentation isn't accidental. It requires infrastructure, coordination, and aligned incentives. By the New York close, silver had sailed above a level that, on paper, invalidated several long-standing technical suppression patterns. Yet there was no follow-through volatility in the options market. Implied volatility remained muted. Gamma exposure stayed concentrated near strike levels that conveniently limited upside acceleration, which raises an uncomfortable question. If silver is truly breaking free, why does every derivative layer appear prepared for an advance? Markets are supposed to react, not anticipate with this level of precision. And when anticipation replaces reaction, it usually means some participants aren't discovering price. They're managing it. This doesn't require conspiracy, only aligned incentives. Bullion banks, clearing members, and large liquidity providers don't need to coordinate explicitly. They simply respond to the same constraints. Those constraints tighten when a market threatens to reprice something fundamental. Silver isn't just an industrial metal. It sits uncomfortably between commodity and monetary asset. History shows that whenever it begins to behave more like the latter, the system responds defensively, not with bans or announcements, but with subtle pressure applied through futures positioning, margin expectations, and timing. The December 19th breakout fits that historical pattern disturbingly well. It was allowed, but only just enough to relieve pressure, reset positioning, and prevent a disorderly rush toward physical settlement. Because disorder is the one thing the paper market cannot afford. This isn't about calling manipulation in simplistic terms or predicting price targets. It's about observing structure, behavior, and timing, and asking why a market that should have reacted violently instead moved as if it were being escorted. Free markets are chaotic. What we saw that night was anything but. As the session progressed, attention shifted away from price and toward the structure supporting it. When markets remain unnaturally calm during moments of technical rupture, the explanation is rarely found on the chart. It's almost always embedded in positioning, settlement mechanics, and incentives that operate out of public view. By mid-morning New York time, COMEX silver futures revealed a subtle but important pattern. Open interest was rising, but not broadly. The increase was concentrated in a narrow band of contract months, suggesting positioning added with intent rather than speculative enthusiasm. Historically, when silver rallies freely, open interest either surges as momentum traders pile in or collapses as shorts are forced to cover. This was neither. It was controlled expansion, indicating new longs were being immediately matched by willing counterparties. Counterparties with balance sheet capacity and no urgency to exit. At the same time, registered silver inventories at COMEX warehouses remained stable, rather than declining as one might expect if futures buyers were preparing for large-scale physical delivery. Eligible inventories, however, quietly shifted classifications. Metal moving on paper, without leaving the system. This has happened before during periods of stress, always serving the same purpose: preserving the appearance of abundance while preventing scarcity from expressing itself through price. That matters because futures markets remain stable on confidence in settlement, not confidence in delivery. And that confidence is maintained by ensuring no single moment forces too many participants to ask the same dangerous question: what if I want the metal instead? During the same window, brief backwardation signals flickered in select silver tenors outside the core futures curve, particularly in OTC forward markets where pricing reflects real-world availability more closely than exchange-traded contracts. These signals vanish within hours, which is precisely why they matter. Persistent backwardation draws attention. Fleeting backwardation suggests intervention, whether through liquidity injection, lease rate adjustments, or short-term supply mobilization. None of that requires conspiracy, only access. By early afternoon on December 19th, margin requirements hadn't changed, but expectations had. Traders began pricing in the possibility of future margin hikes, a psychological lever historically more effective than actual increases. Anticipation alone cools demand. That shift showed up in options markets. Call buying above certain strikes stalled, not because demand disappeared, but because pricing became unattractive. Implied volatility was nudged higher, exactly where upside acceleration would occur. Bullish conviction was taxed quietly, without headlines. This is how modern market control works, not by banning trades, but by altering the cost of expression. Meanwhile, physical silver markets told a very different story. Bullion dealers across multiple regions reported delays, rationing, and widening premiums, even as futures prices suggested ample supply. That divergence matters. It exposes a fault line between paper claims and tangible metal, a fault line that widens slowly until suddenly it doesn't. History shows that when this gap becomes politically or financially inconvenient, paper markets are defended first, not because they matter more, but because they're more fragile. Physical shortages can be blamed on logistics. Paper shortages cannot. As the New York session moved toward its close, silver held its gains with an almost unnatural precision. Settlement prices clustered near levels that minimize losses for dominant option writers. That's a statistical coincidence if it happens once. It's a structural signal when it happens repeatedly, and in silver, it has happened repeatedly, not just on December 19th, but across multiple episodes where price action threatened to reclassify silver from an industrial input into a monetary signal. This is where broader context matters. Silver does not move in isolation. It moves relative to currencies, to real interest rates, and to gold. Yet during this window, silver diverged from all three. Real rates were not collapsing. The dollar was not breaking down. Gold was not leading aggressively. And yet silver moved. When an asset advances without its usual macro drivers, it suggests the catalyst is internal market stress rather than external narrative. Internal stress is far more dangerous because it cannot be addressed with speeches, policy hints, or messaging. It can only be managed through structure, timing, and containment. By the end of the day, nothing appeared broken. There were no crisis headlines, no emergency statements, no official responses. And that in itself is the point. The most effective interventions leave no visible trace. They stabilize without spectacle. They guide without acknowledgement. They rely on the assumption that most participants will never look beyond price. But price is the last place stress reveals itself. Structure is where the truth leaks. On December 19th, the structure of the silver market behaved not like a system discovering value, but like one quietly absorbing pressure, redistributing risk and buying time. To understand why this matters, the timeline has to extend beyond days or weeks and be placed within silver's recurring role in moments of financial stress. Silver has a long history of surfacing when confidence in paper systems begins to erode. Not loudly enough to trigger crisis protocols, but persistently enough to force preemptive containment. This pattern isn't theoretical. It's historical. In January 1980, silver didn't collapse because demand vanished. It collapsed because the system intervened when leverage threatened to convert paper claims into large-scale physical demand. Margin rules were rewritten overnight. Liquidity was selectively withdrawn. What appeared on the chart as a market crash was, structurally, a forced repricing of participation rights. In 2011, silver again approached a threshold where paper exposure risked spilling into delivery pressure. Once again, volatility was not allowed to resolve naturally. Margin requirements were raised 5 times in 9 days. Price collapsed, and the narrative shifted almost instantly from monetary metal to speculative excess. These episodes are often remembered as investor failures. From a system perspective, they were successes. They preserved settlement integrity, discouraged physical conversion, and reasserted the hierarchy between paper claims and metal. The December 19th breakout doesn't match those moments in magnitude, but it mirrors them in shape. A quiet escalation, a controlled ascent, followed by structural signals designed to prevent acceleration rather than reverse it. The key difference is timing. Past interventions were reactive, visible, and blunt. Modern interventions are anticipatory, subtle, and optimized for invisibility. They occur before stress becomes public, before headlines form, before retail participation reaches critical mass. That's why December 19th didn't feel dramatic. Drama is a sign of failure. Calm is a sign of control. But control has limits, and those limits are defined not by price, but by confidence. The silver market functions on the assumption that most participants will never demand delivery at the same time, that futures are tools for exposure, not claims, that any mismatch between paper volume and physical availability will remain abstract. As long as those assumptions hold, containment works, but if they weaken, even slightly, the structure begins to creak. And there are signs that this weakening is already underway, not just in exchange inventories, which can be reclassified or rehypothecated, but in behavior, in the growing preference for allocated metal, in rising distrust of synthetic exposure, in the way participants increasingly talk about silver not as a trade, but as an exit. These shifts don't show up immediately in price. They show up in flow, in tenor selection, in delivery timing, in lease rates, and in the increasing effort required to maintain calm. Effort is a tell. Free markets don't work to suppress volatility. They generate it naturally. Only managed markets expend energy to keep volatility low during moments of stress. And effort always leaves fingerprints, even when no names are attached. If containment holds, silver will likely continue to rise in steps rather than leaps, revalued slowly enough to avoid signaling monetary distress. It will be capped not by sellers, but by design. But if containment fails, the failure won't begin with a price spike. It will begin with hesitation, with delayed settlement, with widening spreads between instruments that are supposed to track each other, with growing discomfort among those whose role is to make markets rather than take positions. Market makers aren't investors. They are insurers of liquidity. And insurers become nervous when claims start to resemble obligations. December 19th may not be remembered as a crisis. It may not be remembered at all. But it fits too cleanly into a pattern that has appeared whenever silver threatens to move from derivative to deliverable, from instrument to asset, from commodity to signal. The uncomfortable implication isn't that silver is being manipulated in a simplistic sense. It's that it's being managed because it has to be, because allowing silver to reprice freely would force uncomfortable questions about leverage, collateral, and trust that extend far beyond one metal. Which is why the most important question isn't where silver is going, but how much pressure the system can absorb before management becomes visible. Because once visibility arrives, calm disappears. And history suggests that when silver finally moves without escort, it doesn't whisper. It speaks loudly, briefly, and with consequences that are never confined to silver alone.